Well, quick check on stock futures. We're a bit mixed at this point, pretty much trading flat. The Dow indicating a higher open, up just around 60 points. And the moves come as this week's tech sell-off has many wondering whether overvaluation concerns have finally hit a boiling point, and if we're now seeing the end of a bull market that's been chugging higher since April. For a deeper dive, let's bring in Schleif, BMO Private Wealth Chief Market Strategist. Carol, there's been a lot going on the past few weeks. A lot of talk of a market bubble, whether we've hit the peak in the bull market. How concerned should investors be with this latest sell-off? Because a lot of strategists have also been telling us that a pullback was coming sooner than later.
Right. Well, a pullback would be normal, especially when you look at the energy that's been deployed coming off of those April lows. So some sort of a pullback in here would be natural. It's important, though, and the one thing that the markets have done very well all year is they might freak out a little bit in the short run, but they keep pulling back to what those fundamental threads, the underlying fundamentals are. And the underlying fundamentals remain pretty solid overarchingly. And we've seen that with tech company earnings, with other company earnings that were coming into the season so far, with something like 2/3 of the S&P having reported. We're talking double-digit bottom line earnings growth, which is pretty amazing for this far in the cycle. And so a pullback would be normal. The underlying fundamentals remain there. And actually, a pullback, I think, would be constructive in here because it allows markets to reset. They had kind of run ahead of things, as markets are wont to do.
So you're saying underlying fundamentals remain strong. How much can that offset the concentration risks within this market? Because we've seen the S&P hit 36 record highs, but just 6 stocks have driven half of those gains. So when you look at this pullback in relation to how concentrated this market is, does that indicate how much deeper the sell-off could potentially go?
It potentially, but you've also got, it's important to remember that those same companies are the ones driving the bulk of earnings and profitability. And you look at them in terms of, it's not like back in the late 90s. I know there's a lot of folks that want to conflate this with what happened in the late 90s, but it's a very different environment in terms of what's driven the earnings and driven the profitability are real companies generating real revenues out of real businesses. They're capacity constrained, which is part of why you've got the CapEx going on there. One of the things we are watching is how those are being funded, because you're seeing some of the funding happening in the debt markets now as opposed to cash flow. So yes, that concentration is there. But up until the past few weeks, we were seeing broadening out. There are other companies, other sectors that play into the build there, from in industrial manufacturing, materials. There are a number of different industries, too, that are generating double-digit earnings growth.
Carol, does that worry you that these Mag 7 players are now funding a lot of their debt or tapping into the bond market to fund a lot of these endeavors?
Yeah, it's definitely something worth watching, and it's worth unwinding, because in my own head, we're trying to figure out, do you get so intertwined? And I think we're very early in that process because they had very strong balance sheets. They're trying to lever responsibly, if you will. They had almost underutilized balance sheets in a lot of cases. But the one thing we want to make sure is that we don't have a concentrated list of companies and funders that become so intertwined that they all become too big to fail. That's one of the things we're watching pretty carefully as well.
And given all the record highs that we've seen, sometimes folks tell us that, when you have some sort of a pullback and you have a little bit of volatility, it's good for investors because you can get in at cheaper prices. So are you advocating to buy the dip at this point, or would you wait on the sidelines a bit more?
I think it depends on client by client where they're at. We call it portfolio hygiene, and we've recommended continuing to rebalance through the year. It's also important to remember from a diversification standpoint globally that the U.S. markets, while they've done really well, have underperformed a lot of global markets. And so being globally diversified and continually rebalancing within that makes some sense. But for clients who have maybe year-end bonuses or early in the year bonuses, having a pullback in order to be able to deploy some of that cash makes sense. For other clients where they've got significant gains year to date and wanting to trim back and rebalance some of that into there, that makes some sense too. It's also great for those clients with appreciated securities to be able to do some year-end gifting to their favorite charities with those appreciated securities.
And finally, Carol, we have a K-shaped stock market, and it's coinciding with a K-shaped economy, with those higher income consumers driving a lot of the resilience that we've seen within the economy. How concerned are you of the link between the stock market gains to that higher income consumer, and how that could potentially bleed through to some of the economic growth that we've been enjoying over the past few quarters?
Yeah, I think that as well. The K-shaped consumer and the K-shaped companies in the economy is definitely worth watching, because you do, as your earlier segments talked about with the consumer companies, you're definitely seeing strain on the lower part of that K, and demographically as well. And so it bears watching, because it impacts a lot of the consumer companies. And you've seen it in some of the earnings reports, where you've got a lot of frontline consumer companies that understand how fraught consumers are with the higher level of prices they're paying now versus 5 or 6 years ago. And you touched on this: autos are expensive, homes are expensive, education. There's just a lot of things going in, making it tough for that lower side. And they're staying supremely value conscious, but they're also making choices in terms of, if they may not travel, as extensively, but they'll do staycations close to home. They may not spend up on certain things, but they'll divert someplace else. But the higher end consumer, as long as housing values and stock market, their spending tends to be much more tied to things like that, as opposed to employment concerns or things like that. And even with a pullback in here, we suspect that when you look at overall net income and values that top tier owns, it's grown substantially in the last few years, not just in the US, but globally as well.
Ben, coming to you, I teased a couple minutes ago, I was really leaning into the doom and gloom I'm seeing in markets this week. How concerned are you that reports, good earnings reports, Palantir, AMD, these reports are being sold?
It's somewhat concerning, Brian, because, that should actually confirm the price of the stock. But I think what people have gotten to is saying, these prices have extended far beyond for where the earnings are projected out in the future. And I think this becomes now in most investors' minds, that I don't want to keep paying up high prices here for earnings that, although they are very good and solid, who knows where it's going to play out next year. There seems to be also maybe some uncertainty about the economy, where we're heading next year. So I think this is why we're seeing the sudden pullback. But then again, Brian, we're going into year end. It tends to sometimes get a little bit this way, a little twitchy. November is also a month that's a very strong month, seasonally strong, but the starts are typically poor. So it's sort of confirming the history that we've been through in November. So I wouldn't hold my breath yet to say this is going to be a bad month, but it is to be noted that people are paying attention to overvaluation, and that becomes part of the narrative.
I like that, Ben. I think that's a perfect way to put it. The market is twitchy. Stick in the headline, guys. That's what we're rolling with. Ben, let me stay with you here, though. We have learned, it's been actually consistently proven over the past few years, dips are to be bought. Every single time there's been a series of bad news, the market has sold off and then it's come back. In the news, I would even argue, Ben, Palantir, that wasn't bad news. AMD's quarter was great. Should investors just continue to use that playbook, though, on buy on the dips?
I think so. In the sense that as you say, is a kind of conditioned way of looking at the market, as you showed it in the graph. So people pay attention to that too, to say, okay, this dip is coming, it feels pretty good. Therefore, I can step in here. I feel like I have some cash on the sidelines. So all that psychology is all there to rally even further from here. But let's keep paying attention to this price, right? Let's keep paying attention to the twitchiness of the market, because it's not there for nothing. Overnight, for example, is a really sharp decline in the Nikkei and in the Kospi, the Korean index. There's other examples out there that this is not just here in the US, but places elsewhere. So I do think that buying dips is an opportunity here, but you may want to take a step back here and wait for this a bit wash out before you do it, because of, we don't know when the government's going to reopen, as one example, which we need some more visibility on the economy too. We've got good ADP data today. That's encouraging, but we don't have enough visibility. And globally, it seems to be playing out the same way. So I'll be a little careful here.
Ines, what's your take on this twitchy market?
Look, I mean, so much has been priced into the market already. These valuations, investors are questioning these high valuations, and they're looking at these stocks that have doubled in price, that have done very well this year, like Palantir, for example, that AMD was down in pre-market, but it's not that down that much. I mean, it's little changed right now, and AMD has gone up 107% year to date. With not a lot of visibility with respect to what the Fed has on hand, what it will do in December, with the government still shut down. The question is, are we going to go into the end of the year with a Santa Claus rally? And Wall Street is looking at seasonality. It's looking at the fact that it ended October on a good note, and 80% of the chance when that happens, when you end in green territory, you will see gains for the markets in November and December. UBS saying that they expect this rally to continue. When you see stocks going down the way they did yesterday, you question, is this a buyable dip? Will the markets go higher, or are we going to see a leg lower?
Ines, I love some of the headlines I saw coming in this morning. The one that stuck to me, and I even mentioned in my intro because why not? $500 billion lost on the Philadelphia Semiconductor Index in, 2 days, as if the world is ending. Lost in a headline like that, Ines, is, look, the companies continue to do very well. AMD didn't miss estimates. They did not show profit growth. This is not world-ending pullback here and we're headed into a bear market. I mean, that's just not the case.
No, and Wall Street has also talked about the strong quarter. You even have Citi that's saying, you may see some pressure on the stock because of slowing Q over Q growth in AI business. But they're expecting the company to raise its long-term guidance at its Analyst Day. You also had Lisa Su that was talking about the partnership with OpenAI and how this will accelerate their AI business, and they could see $100 billion in revenue over the next few years. So Wall Street has a lot that they like with a company like AMD, and AI is still the driver of these markets, and what Wall Street is expecting the markets to go higher with their year-end targets and going into next year, and it is in part and mostly because of AI.
Well, stocks rebounding from Tuesday's sell-off, fueled by better-than-expected private payrolls data. ADP reporting 42,000 jobs added in October. That was a marked turnaround from September's revised decline of 29,000. Still, with the surprisingly positive report, Fed Governor Stephen Miron points to the labor market as a bigger risk than inflation in his conversation with Yahoo Finance this morning.
I'm more sanguine on the inflation outlook than a lot of my colleagues are, in particular because I don't view tariffs as driving a material amount of inflation. I think policy is too restrictive, and that we're too far above where neutral rates would be. And given the state of the labor market, I think that continuing to run policy that restrictive is to also run unnecessary risks.
Joining me now with his take on current Fed policy, we got Brad Conger, Hurdle Callahan Chief Investment Officer. Brad, great to see you, especially on set. Let's start there, because Stephen Miron talking to Yahoo Finance today, but I'm interested to get your take, Brad. You look ahead to that Fed meeting in December. Will they cut? Should they cut, Brad?
I think the data is moving in their way, and here's why. The announcements we've seen on layoffs from Starbucks, the big tech companies, Cisco, Microsoft recently, UPS, tens of thousands. I think that's going to flow through to numbers. Whether the government records those numbers or not will be the open question. But I think it's trending for a cut.
So it's trending for a cut, but we heard from Jay Powell, and you heard that was kind of the headline at that presser when he says, hey, December cut, no sure thing, far from it. Let's say you didn't get the cut, Brad. I'm curious, just hypothetically, you didn't get the cut, you got a pause. I'm interested what you think the market reaction would be to that.
It depends on the messaging that he gives around that pause. Is it a bullish pause? I mean, is it a hawkish pause or not? I think Powell's comments last week were just, I need the market to reset to 50-50 and let the data guide them to the conclusion we're coming to, because we're looking at the same data you are.
Let me switch to another big theme in the markets, and that's these new concerns, or at least new questions about AI valuations. And I'm curious how you're thinking through that.
So we're cautious, and I'll tell you why. it seems like this is a sector where there are a lot of unresolved questions about what business models are going to work, how much people are going to pay, where the compute is going to happen, and the valuations are suggesting that it's a clear path to trillions of dollars of revenue. I'm not saying that's not going to happen. I'm just saying that it's more likely that we get an air pocket at some point because of DeepSeek or because ChatGPT 6 doesn't have the same uplift in efficacy as we've seen. In other words, the models start to roll over in terms of effectiveness.
So you're broadly cautious, Brad. I'm just curious, how does that translate into investment implications? Like, does that mean, hey, I just want to avoid this AI trade, take those Mag 7 names, rip them out of my portfolio? What does it mean?
Well, we're underweight. Yeah. What does that mean? So if the Mag 7 plus the AI-related names are 40% of the market, in our portfolios, they're more like 28, 27. So in our world, that is a relatively big bet against those. No one's going to zero these things out, right? That's crazy.
If you're underweight there, where do you want to be overweight? Where's the opportunity?
We like Europe, based on valuation.
You still like Europe?
Yes.
I've heard people pounding the table on Europe, still attractively valued.
It's the gap between the U.S. and the European valuations is extreme. And we're not saying that Europe merits a U.S. type valuation, but it's wider than normal by orders of magnitude. So if just a little bit goes right in Europe, and the earnings are coming out really nice. I mean, we had a great season in the U.S. Europe is equally having a great earnings season. And so I think Europe has stopped getting worse, and that's the good news.
Brad, I want to get you out on this. Supreme Court now, our esteemed justices, they're weighing the legality of those Trump tariffs. Interesting, you know, as our correspondent Ben Werschel was pointing out, even the conservative justices perhaps sounding skeptical. And I'm just curious, as an investor, how are you trying to think through that?
So it's almost like what I'd prefer is they're struck down. But what I think will happen is, because there's more chaos on the strike down side, which is Trump, the administration is going to try to replace them based on other theories of
other
trade.
levers and tools.
Exactly,
play, for sure.
What does that create? More uncertainty. What does uncertainty do? Corporates pull back on investment. So I almost, as an investor, I want stability. I'd rather have them in place. But I think the rational thing to do is to strike them down. I personally, when I read the emergency powers, it doesn't have the authorization.
All right, we'll see if our Supreme Court justices agree with you, Brad. We'll find out. Thank you, sir. Great having you.
Enjoyed it. Thanks.